I was monitoring the pre-market action when the most calculated assault on retail silver traders in modern market history began to unfold with surgical precision, targeting every psychological and technical vulnerability that individual investors possessed while exploiting the reduced liquidity conditions of Ghost Week to maximum devastating effect. Thursday, December 19th, 2025, 6 almost a.m. Eastern Time. The moment I realized that what appeared to be organic market volatility was actually a methodically planned liquidation campaign designed to transfer wealth from retail hands to institutional balance sheets through the systematic exploitation of stop-loss orders and margin requirements that most individual traders never fully understood until they became victims. The opening sequence was choreographed to perfection, beginning with silver futures gapping up from Wednesday's close of 77.45 to an immediate print of 85.90 that triggered every momentum algorithm and breakout trading system simultaneously, while creating the psychological conditions necessary for maximum retail participation in what would become their systematic destruction. For exactly 19 minutes, the rally appeared genuine and sustainable, as buying pressure intensified and silver pushed through resistance levels at 86, 87, and $88 that technical analysts had identified as critical breakout points that would likely confirm the transition to the next phase of the precious metals supercycle. Retail traders who had been waiting months for confirmation that the silver bull market was resuming began executing their predetermined trading plans with increasing confidence, purchasing call options, adding to existing positions, and placing buy-stop orders above resistance levels to ensure they wouldn't miss the anticipated acceleration toward $100 silver that fundamental analysis suggested was inevitable given the structural supply deficit and accelerating industrial demand from technology companies expanding production capabilities for 2026 operations. The institutional trap was sprung at exactly 9:49 a.m. with mechanical precision that revealed extensive preparation and detailed knowledge of where retail stop-loss orders were concentrated throughout the price structure. Massive coordinated selling began hitting the market in waves specifically timed to create maximum psychological damage while exploiting the thin liquidity conditions that characterized holiday trading when most professional participants were absent and normal market-making activities were substantially reduced compared to typical trading sessions. The mathematical precision of the attack was extraordinary in its calculated brutality, targeting specific price levels where technical analysis indicated retail traders would have placed protective stop-loss orders based on widely published trading education materials that taught individual investors to limit their losses by placing automatic selling orders below key support levels. The institutional selling algorithms were programmed to identify exactly how much downward pressure was required to breach each support level by the minimum amount necessary to trigger retail liquidation orders while minimizing the amount of silver that the manipulating institutions had to sell to achieve their strategic objectives. Support at $85 was violated by exactly 14 cents at 9:51 a.m., triggering thousands of stop-loss orders from retail traders who had placed protective selling orders based on technical analysis that suggested a break below this level would indicate the failure of the breakout attempt. The forced selling from triggered stops provided immediate liquidity for institutional buyers who absorbed the panicked retail selling at artificially depressed prices while preparing for the next phase of their systematic liquidation campaign. Support at 83.50 was breached by 11 cents at 10:17 a.m., creating another cascade of automatic selling orders from retail momentum traders whose systematic approaches required them to exit positions when predetermined technical levels were violated. The pattern repeated with mathematical precision at $82, $80, $50, and $78.75, each breach calculated to maximize the number of retail positions that would be automatically liquidated while providing institutional accumulation opportunities at progressively more attractive prices. By 1:45 p.m., silver had touched an intraday low of $76.85, representing a decline of $9.05 from the morning high and creating one of the most bearish-looking candlestick formations in precious metals trading history. The daily chart displayed what technical analysts immediately recognized as a classic shooting star pattern, characterized by a massive upper shadow representing the rejected rally attempt and a relatively small real body, indicating that prices had settled near the session lows despite the dramatic morning strength. The shooting star formation would typically be interpreted as a powerful bearish reversal signal, suggesting that the bulls had lost control and that significant additional weakness was likely in subsequent trading sessions. However, the forensic analysis of volume patterns, timing sequences, and institutional order flow revealed that this technical formation was the result of calculated manipulation rather than genuine selling pressure from fundamental holders of silver positions who had lost confidence in the metal's prospects. The critical evidence that exposed the artificial nature of the decline came from the physical silver market, which demonstrated complete indifference to the paper price collapse and maintained pricing structures that reflected actual supply and demand conditions rather than temporary derivatives market manipulation. Major bullion dealers throughout North America and Europe refused to reduce their premiums or adjust their inventory pricing despite the apparent weakness in COMEX futures markets that supposedly represented the global benchmark for silver valuation. APMEX, SD Bullion, JM Bullion, and Provident Metals maintained their Silver Eagle pricing at $89.92 per ounce throughout the entire paper market decline, effectively ignoring the $9 futures market collapse that should have provided them with opportunities to reduce their costs and offer more competitive pricing to retail customers seeking immediate physical delivery. When questioned about their pricing decisions during such obvious spot market weakness, dealer representatives consistently explained that their replacement costs hadn't changed and that they viewed the COMEX action as temporary technical manipulation that didn't reflect legitimate silver scarcity or availability in physical markets. The persistence of physical premiums during paper price weakness created an unprecedented arbitrage opportunity that should have attracted massive professional trading interest, seeking to profit from the obvious price discrepancy between artificial futures quotations and legitimate physical market pricing. The absence of arbitrage activity suggested that sophisticated market participants understood the temporary and manipulative nature of the futures market decline and were positioning themselves for the inevitable price recovery rather than attempting to exploit the spread between paper and physical quotations. European precious metals dealers exhibited even stronger resistance to the COMEX price action, with London and Zurich-based merchants continuing to base their quotations on Shanghai Gold Exchange pricing rather than American futures markets that were clearly being manipulated during reduced holiday trading conditions. This geographic pricing arbitrage provided additional confirmation that Thursday's decline represented a localized paper market event rather than a fundamental reassessment of silver's value by global participants who actually traded physical metal for industrial applications and strategic reserve purposes. The institutional strategy became increasingly apparent through analysis of the selling wave timing and volume characteristics that revealed systematic exploitation of retail trading psychology and technical analysis methodologies. The heaviest selling consistently occurred at precisely the moments when retail traders would be most vulnerable to psychological pressure, immediately after stop-loss levels were breached, during lunch hours when attention and monitoring were reduced, and at exactly the times when algorithmic momentum systems would reverse from buying programs to selling programs based on technical indicator signals. This wasn't emotional or fundamental selling driven by changed economic conditions, negative news developments, or reduced confidence in silver's long-term prospects. This was systematic exploitation of retail trading patterns by institutional participants who possessed detailed knowledge of where protective orders were concentrated and exactly how much selling pressure would be required to trigger cascading liquidation events that would provide them with accumulation opportunities at artificially favorable prices. The Ghost Week timing provided optimal conditions for this manipulation strategy because reduced institutional participation and substantially lower trading volumes meant that smaller amounts of coordinated selling could achieve maximum price impact and psychological damage. With most professional traders absent for holiday periods and normal market-making activities operating at reduced capacity, institutional predators could execute systematic liquidation campaigns that would have been impossible during periods of normal market participation and oversight. The volume analysis provided compelling evidence supporting the manipulation hypothesis, revealing that the dramatic $9 price decline was achieved with relatively modest trading volume compared to previous genuine selling events in silver markets. Authentic selling driven by fundamental concerns or widespread loss of confidence typically generated much higher volume levels as multiple categories of sellers competed to exit positions simultaneously, creating the heavy transaction activity that characterized legitimate market moves rather than technically engineered price manipulation. The options market provided additional confirmation that sophisticated traders weren't positioning for continued weakness or fundamental deterioration in silver market conditions. Put option volumes remained relatively light despite the dramatic price decline, indicating that professional participants viewed the weakness as temporary and technically motivated rather than fundamentally meaningful for silver's longer-term outlook. If Thursday's decline represented genuine bearish developments, options traders would have dramatically increased their put buying or hedged existing long positions through derivative strategies. The international market response contradicted normal patterns associated with legitimate silver weakness, with Shanghai silver trading remaining firm and Asian buyers treating the artificial decline as an unexpected purchasing opportunity rather than a signal to reduce their strategic accumulation programs. Chinese industrial buyers continued their systematic procurement activities, while European wholesale markets maintained pricing structures that ignored the temporary COMEX weakness and reflected actual physical market conditions. This global market disconnect reinforced the evidence that Thursday's action represented a concentrated American paper market manipulation event designed to exploit specific technical conditions during Ghost Week, rather than a broad-based reassessment of silver's fundamental value by international participants who required actual metal for industrial production and strategic reserve purposes. The psychological warfare aspect of the operation was as sophisticated as the technical execution, designed to create maximum emotional damage among retail traders who had developed confidence in silver's prospects during the November-December rally. Many individual investors had purchased positions based on fundamental analysis, suggesting that industrial demand growth would support continued price appreciation, making the violent technical failure particularly traumatic and likely to create lasting reluctance to reestablish positions even when prices began recovering. The shooting star candlestick pattern created by Thursday's action would psychologically haunt retail traders for weeks or months, serving as a constant reminder of their vulnerability to institutional manipulation and reducing their willingness to participate aggressively in future rally attempts even when fundamental conditions strongly supported higher prices. This psychological suppression was as valuable to institutional accumulation strategies as the immediate price impact achieved through the stop-loss liquidation campaign. The broader strategic context revealed that sophisticated institutional players were positioning themselves for the massive capital inflows expected in January 2026 as pension funds, endowments, and sovereign wealth funds implemented annual portfolio rebalancing decisions that typically increased commodity allocations at the beginning of new calendar years. These seasonal flows often created substantial buying pressure in precious metals markets as institutional managers executed investment committee decisions made during year-end strategic planning processes. The Ghost Week manipulation provided an ideal opportunity to accumulate large silver positions at artificially depressed prices before institutional buying pressure resumed in early 2026, while simultaneously reducing retail competition for available supplies by psychologically damaging individual investors and forcing them to liquidate positions at substantial losses during the technically orchestrated decline. The regulatory environment facilitated the manipulation by operating with reduced oversight during holiday periods when most compliance and surveillance personnel were absent, creating temporary immunity for institutions conducting systematic liquidation operations that might attract investigation during normal regulatory monitoring periods. This oversight gap provided the perfect window for executing sophisticated predatory strategies against retail participants who lacked the resources and knowledge to defend themselves. The industrial demand context made the manipulation particularly cynical because technology companies, solar manufacturers, and electric vehicle producers required massive silver supplies for 2026 production expansion, regardless of temporary paper market pricing. These fundamental buyers viewed artificial price weakness as welcome opportunities to accelerate their strategic procurement programs, while retail traders were being systematically destroyed through technical manipulation that had no relevance to silver's actual scarcity value or industrial necessity. The January 2026 setup was becoming extraordinarily favorable for explosive price appreciation, as the manipulation operation successfully cleared leveraged retail speculators from the market, while concentrating ownership among fundamental buyers with unlimited financial resources and strategic imperatives to secure adequate silver supplies for critical production requirements. Pension fund capital inflows, industrial procurement acceleration, and reduced speculative selling pressure were aligning to create conditions for sustained price advances that could dwarf the volatility experienced during Ghost Week trading sessions. The technical chart patterns emerging from Thursday's action revealed multiple layers of institutional positioning that extended far beyond the immediate stop-loss liquidation campaign. The shooting star formation was accompanied by massive volume spikes at specific price levels that indicated institutional accumulation disguised as technical selling, with smart money using the artificial weakness to build substantial positions, while retail traders focused on the obvious bearish implications of the candlestick pattern that dominated their technical analysis frameworks. The institutional footprints were visible through careful analysis of the bid-ask spread behavior during the most violent selling periods, revealing that sophisticated buyers were consistently stepping in during moments of maximum panic to absorb the forced liquidation orders at prices that provided substantial discounts to prevailing physical market quotations. These accumulation signatures suggested that the manipulation operation was serving dual purposes: extracting retail positions while simultaneously allowing institutional participants to build strategic reserves ahead of the anticipated January buying wave. The options market dynamics provided additional insight into the sophisticated nature of the operation, with unusual activity in January and February call options suggesting that institutional participants were positioning for rapid price recovery once the liquidation campaign concluded. The pattern of call buying during maximum paper price weakness contradicted normal retail behavior and indicated that sophisticated traders understood the temporary nature of the technical manipulation while positioning for the inevitable snapback rally. The global market response patterns revealed the truly international scope of the institutional positioning, with European and Asian markets demonstrating coordinated resistance to the American paper market manipulation through maintained physical pricing and continued strategic procurement activities. This geographic arbitrage persistence suggested that global industrial buyers and sovereign entities had developed independent assessment frameworks that ignored short-term COMEX volatility in favor of long-term supply security considerations. The regulatory implications of the systematic stop-loss targeting raised questions about market structure integrity that would likely generate investigation once normal oversight resumed in January, potentially leading to rule changes that would make similar manipulation operations more difficult in future trading periods. However, the immediate impact favored institutional participants who had successfully executed their accumulation strategies during the temporary oversight gap. The psychological warfare elements of the operation revealed sophisticated understanding of retail trader behavioral patterns, with the timing and magnitude of the decline precisely calibrated to create maximum emotional trauma while avoiding the obvious manipulation signatures that might trigger immediate regulatory response or widespread media attention that could expose the institutional strategy before completion. The fundamental demand trajectory remained completely unaffected by the paper market manipulation, with industrial consumption requirements continuing to accelerate toward 2026 production targets that would require unprecedented silver availability regardless of temporary futures market volatility. Technology companies maintained their strategic procurement timelines, while retail traders absorbed the psychological and financial damage from the systematic liquidation campaign. The supply chain implications of the manipulation operation extended beyond immediate price impact to long-term availability patterns, as industrial buyers used the artificial weakness to accelerate their procurement schedules and secure additional inventory before normal market dynamics resumed. This demand acceleration would likely create more severe shortages in subsequent months, as industrial consumption exceeded mining production by even wider margins than previously projected. The currency market backdrop provided additional context for understanding the institutional motivation behind the manipulation operation, with dollar strength creating temporary headwinds for commodity pricing that institutional buyers exploited through coordinated technical operations designed to amplify natural currency-driven weakness into systematic retail liquidation campaigns that provided accumulation opportunities at maximum discounts to fundamental value. The interest rate environment contributed to the effectiveness of the manipulation by creating margin pressure on leverage positions that made retail traders more vulnerable to stop-loss liquidation during periods of artificial volatility designed to trigger automatic selling orders. Institutional participants with superior funding costs and risk management capabilities exploited these structural vulnerabilities through precisely timed technical operations. The technical damage from Thursday's shooting star candle would require several sessions of constructive price action to repair, with the key test being whether institutional buyers would defend the $76.85 low as a legitimate support level or allow additional manipulation to drive prices lower before implementing their accumulation strategies. However, the fundamental drivers supporting silver demand growth remained intact and were actually strengthening as technology companies expanded production capabilities that would require unprecedented silver consumption during 2026 operations. The artificial nature of the decline suggested that recovery could be rapid and violent once normal market participation resumed, and institutional buyers began absorbing any remaining selling pressure from retail traders who had been psychologically damaged by the systematic liquidation campaign. The critical technical question was whether the shooting star formation would prove to be a genuine reversal signal or simply a brutal liquidity extraction operation before the next phase of the silver bull market acceleration. The physical market's complete refusal to acknowledge the paper price decline provided the most compelling evidence that Thursday's action represented successful institutional predation rather than legitimate silver weakness driven by fundamental concerns or reduced industrial demand. As long as bullion dealers maintained elevated premiums and industrial buyers continued their strategic accumulation programs, the COMEX price manipulation would remain disconnected from silver's actual value and availability in markets where real metal changed hands for immediate delivery. The Ghost Week liquidation campaign had successfully achieved its tactical objectives of extracting retail positions and providing institutional accumulation opportunities at artificially favorable prices, but the strategic transformation of silver from a precious metal to a critical industrial material remained unchanged and would ultimately overwhelm any temporary paper market manipulation as fundamental scarcity asserted itself through natural economic forces that no amount of derivatives trading could permanently suppress. The shooting star candle would eventually be remembered as the final successful retail liquidation operation, before silver entered a sustained institutional accumulation phase driven by industrial necessity that transcended financial market manipulation and established pricing based on actual physical availability rather than paper contract arithmetic designed to benefit sophisticated predators at the expense of individual investors who lacked the knowledge and resources necessary to defend themselves against systematic wealth extraction campaigns. The path to $100 silver remained intact despite Thursday's technical destruction, with the manipulation actually strengthening the fundamental case by demonstrating that institutional participants understood silver's strategic value sufficiently to risk substantial capital and regulatory attention, executing complex liquidation operations designed to accumulate positions before industrial demand growth made current price levels appear absurdly cheap in retrospect. The retail traders who had been stopped out during Ghost Week would be forced to repurchase their positions at much higher prices once normal market dynamics resumed and industrial reality reasserted control over silver valuation mechanisms.